We are back with the week that was in the economics world. So we did get a few data points this week, not so much as we will be getting next week, but we did get the leading indicator, which is mainly supposed to show us or give us indications of where economic growth could be headed in the near term. So that's what the leading indicators mainly are used for, but it covers a broad spectrum of subcomponents, right? Ranging from sentiment, such as business confidence. They also cover activity, such as your new vehicles sold, for example. And then they would also cover some income perspectives, such as commodity price index. So what we've generally seen this year, when you look at the leading indicator, is yes, there will be volatility in terms of the momentum that we see on a monthly basis. So this data that we received for September did once again show us that momentum did slow in terms of our expectations for economic growth going forward. But what has been quite consistent is when you look at the year-on-year numbers, you will see that generally speaking, this year growth should outpace what we saw in 2024. So there's still positive indications on that front. So when you go back to the September number, what really contributed negatively to the indicator was so it was mainly the number of building plans passed, of residential building plans passed, that is. And I guess it really speaks to the story that we've been telling in terms of the housing market, where you are seeing an improvement in property prices, but that is mainly driven by the supply side rather than the demand side. So it's around stock issues, for example, that is driving higher property prices. But demand really still needs to get the pace, especially as we see confidence improving as well as interest rates going down. So that would be something that would be supportive to better volumes in terms of demand for mortgages. But generally speaking, the fact that we've been seeing the number of building plans passed not really being very conducive, it also speaks to a construction market as well that would be hand in hand with weak economic activity. So you don't see very robust growth in the construction sector. The other indicator that contributed negatively was, the trend growth rate. So they look at the 6-month smoothed growth rate in new vehicle sales. And yes, this would suggest that the momentum in the new vehicle sales market is probably slowing, but we're still looking at monthly numbers that show us, multi-year highs in terms of the number of vehicles sold. So there's still a lot of positivity on that front. And I guess looking at it in general, you would see that new vehicle sales are sort of highlighting the fact that economic activity is starting to pick up. The main contributor in terms of on the positive side, so the positive contributor here was the rise in the US dollar denominated commodity price index, which once again highlights what's been happening in terms of your precious metals, haven demand, but it also just speaks to the income side of the mining sector, which could be improving, but we still need to see a lot of gains on the volume side as well. The other indicator that came out this week was the producer price index, which once again gives us an indication on prices from a producer point of view. And we did see 2.9% year on year here, but the monthly numbers are still in deflation, right? So it's similar to the CPI where, when you look at the index on a year-on-year basis, especially as we left 2023 with very high inflation, and the index had risen quite a bit, so the level was higher. And then you went into 2024 where the level started to taper off. So when you compare the numbers on a year-on-year basis, you would have seen towards the end of 2024 how inflation really started to pull down. It was mainly what we call a base effect. And then obviously in the latter part of 2025, you will see that positive, impact from that base effect starting to fade. And that's exactly what we're seeing in the numbers. So in both PPI and CPI, you're starting to see a lift in those inflation numbers, even though on a monthly basis, the momentum that is shown in prices is really still very weak. But what really drove that year on year acceleration was food and beverages. So there is a little bit of pressure there, but once again, highlighting base effects. And then we also did see from petroleum, chemicals, rubber, plastics, that also contributing quite a bit to annual producer inflation. What also contributed was furniture and other manufacturing. But here, unlike the other two, we did see monthly pressure as well. So that seems to be something that's building there. But overall, I mean, PPI at 2.9% still suggests to us that we still have contained inflation in South Africa. It's still around that 3% that is currently, that is the new target. And PPI being a leading indicator for consumer inflation really suggests that there probably isn't much that is building up in terms of goods inflation.